So just a quick reminder again, we're going to be, we have an event coming up in July in Austin, Texas, and we welcome anybody who wants to be out in Texas with us. We expect it to be a larger event with around 250 to 300 people online and around 30 to 50 people in person. We're going to move on to Alan Segalevsky, and Alan is a former economist with Goldman Sachs. He'll do an introduction of himself. He has a macro advisory firm. And Alan, are you there?
I am here. Can
Perfect.
you hear me? Can you see me? Is everything going the way it should be?
Just like, yes, we can see you and hear you. Do you have a slideshow you wanted to present and talk about? Great, perfect.
I'll put that up.
Now, Alan, as I was saying, I think we spoke on the phone last week, and it was very interesting because we've had two totally divergent viewpoints on the economy, with Ed Yardeni, very positive, and then Ken Fryer, who is the ex-chief investment officer of Stanford University, not as positive. So love waiting to hear what you have to say, and maybe you might have some insight into CLOs as well.
All right, fantastic, Marty, and thank you for the introduction and for everyone who joined in for the presentation here. So as Marty mentioned, I founded and I'm the chief macro strategist at Xallarap Advisory. I founded it after almost a decade at Goldman Sachs as a senior market strategist. And, you know, in terms of what we do, it's actually, the explanation is pretty straightforward. We predict market performance. And that means US equities, it means interest rates, it means not just the US, it means Europe, it means Japan, it means China, so on and so forth. And so in a nutshell, our clients are, they're kind of a mix. It's proprietary traders at boutiques that are essentially looking for information about whether the markets they trade have a headwind or a tailwind. Similar explanation goes for small asset managers that we work with. And at the moment, I guess most relevant for this forum here, we do have one family office. And there it's more on a consultative basis for the purpose of making tactical investments. So if they have an existing, call it diversified portfolio, it might be along the lines of, okay, should I overweight one asset class, underweight another asset class based on what we're seeing? Or maybe something like introducing a brand new asset class to their portfolio that maybe they didn't have before. So that's basically what we do in a nutshell, and you'll see some of that in the presentations here. So let's dive into the deck, because I also want to make sure that that we have time for questions. So the main takeaways here, as I often like to joke, in case you really just want to listen for the first few minutes and have everything you need to know on one slide, it's that there's been a lot of talk about uncertainty for months now. I feel like I hear that word more than any other, but it's important to keep in mind that uncertainty actually doesn't have any meaning unless you also consider certainty, and I'll explain a little bit more about what that means. In terms of the economy, we think that U.S. growth is improving, but it's one of those situations where it's improving from an incredibly low level, and we still actually think we will be at negative growth by the end of the year, but an improved level of negative growth than where we are now. Our call on the S&P 500 is that it reaches 3530. If I had to guess, at least some of you are probably wondering if that's a misprint. It's not. And so again, I'll explain a little bit of that in a few slides. And finally, we expect the 10-year Treasury to be at 1.25% at the end of the year. And then some of you might even think that's a misprint, and I can assure you that that is not a misprint. So let's start with the uncertainty subject. So the reason why I started focusing so much on this a few months ago is because when I was relocated at what was, I guess, my first relocation of several, I won't mention how many at this point. I spent 35 minutes going to the supermarket, 35 minutes coming back from the supermarket, a few times a week. And during that drive, I would listen to the radio and I would hear commercial after commercial that basically repeated the exact same words, call it 3-4 words maybe, that were essentially identical. They were unprecedented, unexpected, unclear, and of course, uncertainty. And so I started thinking about this concept of uncertainty. And what I realized is, yes, it's easy to pinpoint when there's more uncertainty and less uncertainty, but it's also really important to think about how much certainty is in there. In fact, you can't really appreciate uncertainty unless you also know how much certainty there is. So here on this slide, you'll see just a few kind of choice quotes that I took from the Financial Times that all reflected the use of the word uncertainty. But the reason why I call this presentation Markets and the Princess Bride is because with all the talk of uncertainty, it was this quote at the bottom of the slide that popped into my head, which was, "You keep using that word. I do not think it means what you think it means." And so now let's kind of dive into comparing uncertainty to certainty, which I think is a lot more relevant. What drove this analysis here, and I'll explain it, what drove the analysis was a little bit of call it like a thought experiment, a little bit of a pet project, one of those where if it turns out to be a total failure, you wouldn't even mention to anyone that you bothered looking into it, that kind of thing. What ended up happening, though, is that the results were incredible, not because statistically the results on their own are results that you can trade the markets on or something like that, but incredible in the sense that this was just a simple thought experiment that popped into my head as maybe worth doing. So what you're actually looking at here is a comparison of the uncertainty data that Google Trends provides, as well as the certainty data that Google Trends provides. And remember, the argument I've been making here is that you have to compare uncertainty to certainty. You can't just look at each of them individually. So what I did is a simple ratio, the uncertainty levels versus the certainty levels, and how they changed over time. And my theory was, I wonder if there's something that might relate how that ratio changes to how the stock market performs. Well, here you have it. Now, as you could see, the two lines, the green and the blue, they don't overlap anything close to perfectly, but there is somewhat of a clear relationship. And what we did in the chart is we held back the uncertainty to certainty ratio by 4 months. Now, what does that mean? What it means is it was our way of testing, is it possible that what happens to the uncertainty to certainty ratio 4 months before eventually tells you what happens to the S&P 500 4 months later? So the reason why I have those call outs with the dates is to give you an idea as to, that point at the top, that's December 2019 for the S&P 500's year-over-year return. The same point just below it for the uncertainty to certainty ratio is obviously 4 months earlier, August 2019. But again, we shifted the dates for the uncertainty to certainty ratio so that you could see what they look like lined up when it's really 4 months that is between them. And you can see that, yeah.
Alan, how is uncertainty different than volatility?
So uncertainty is, this is going to be an answer that's kind of like an answer that's not even a helpful answer, but uncertainty is more of a kind of theoretical, philosophical concept in a sense. The Google Trends data and this is, by the way, this goes back to exactly why this was such a sort of thought experiment pet project, because it's not as though having data from Google Trends on uncertainty, which, by the way, all that does is it tells you how popular is the search on Google for the word uncertainty. it's not as though that type of data point really explains exactly what uncertainty is, but more so, I thought that it's an expression of how over time you can get a sense of how much uncertainty in the world is rising or falling. And the same thing goes for certainty. Volatility, on the other hand, is more of a measure of simply how much is the stock market, or frankly anything, doesn't have to be the stock market, how much is the market, let's say, fluctuating up and down. So they're in a sense related in the way that, let's say, if there's more uncertainty in the world, you might see markets become more volatile. If there's less uncertainty, you might see them become less volatile. But again, I would kind of emphasize that uncertainty and certainty here are being used more in sort of that kind of philosophical sense, for lack of a better way to put it.
Okay, let's move on.
So in a nutshell, again, I put the labels on the chart, the dates, just to show how that 4-month gap relates to certain points. And the reason I picked the points at the top and the points at the bottom that I labeled is because the points at the top show you where the market performed on a year-over-year basis at an exceptionally high level. That's why that green data point that December 2019 is pointing to is so high on the chart. And at the same time, March 2020 at the bottom, we know is due to the pandemic, when the market basically tanked. Now, what you'll notice, and this was the incredible part of the analysis, is that in August 2019, for this ratio, which was 4 months earlier, it also peaked. And when did it bottom? Well, it basically bottomed in November 2019, which was, again, exactly 4 months prior to March 2020. And so what the takeaway here really is that, yes, of course, there has been so much uncertainty in the world over the last few months, a lot of it related to very, very specific issues. How many cases are there going to be? Is the trend higher? Is the trend lower? What is the health impact in the short term of COVID? What is the health impact over the long term of COVID? But the thing is, all of that uncertainty is about a very, very particular subject, which is a virus. Now, that's not to discount, of course, that the impact of the virus could be considerable, but all the questions that we were looking for answers to, they related to a virus. And we started thinking about them before the virus had even spread as far as it did. But there was also so much more certainty, so much more that we did know, but that we weren't focusing on, precisely because when there's a global pandemic, it's really hard naturally to focus on all the things you do know, when a global pandemic is probably something out of fear that you're going to naturally focus a lot more on. So what this basically tells you, again, for the purposes of a simple thought experiment, is that uncertainty is one thing, but it's only useful if you really compare it to certainty. So this, from here, it also sort of got me thinking more along the lines of, well, what are some of the other things that we're very certain about? And one of the ideas that popped into my mind was, there has been a lot of talk, rightfully so, about central bank policy. They've been flooding the markets with countless different new programs, or programs that existed before but maybe haven't been used for a while. But what all of it really boils down to is that they are drastically increasing the money supply. I mean, that's pretty much what central bank policy of all types eventually boils down to. And I had seen a lot being written about how the policy measures taken by the central bank are not going to help the markets. There's so many economic issues that need to be worked through. And there was a lot of focus on the money supply. And so I thought to myself, these two issues have been kept kind of distinct. They've been separated from each other. How come nobody's actually just created a simple ratio that compares where the S&P 500 is trading to how much money is out there, and looks at how that ratio changes over time to see if maybe it means anything about the magnitude of future market returns? And these results were truly eye-opening and incredible, precisely because there weren't any outliers and the results are just so clear-cut. And in the world of statistics and trying to figure out if results you get are meaningful or useful, I mean, this was incredible. So here's what it boils down to. When the S&P 500 to money supply ratio hits a bottom, the next 1 year of stock market returns has an average of 31%. And I've listed 10 of those periods on the left chart. You'll notice that the worst, I mean, it sounds strange to say it, the worst 1 year period after a bottom in the ratio is 19%. I would argue that if that were somebody's worst equity returns on a year-to-year basis, they would be very happy with that. On the flip side, on the right chart, what you see is the opposite situation. When the ratio peaks, the subsequent 1 year return of the equity market averages negative 12%. And you see 10 examples of that taking place where the best 12-month performance after a peak in the ratio is a meager 2%. And I'll just say for some context, what is the average 1 year performance of the S&P 500? It's 8%. So the reason why I was mentioning at the beginning here that the results were so clear cut is that there aren't any outliers here in the sense of relative to that 8% average, no matter what the environment is, maybe you would have expected that some of the results in the left chart could have fallen below 8%, maybe some of them. Or on the right chart, maybe some of the results would have been above 8%. Those would kind of have been the outliers that might, skew the results a little bit. But here, it is about as clear cut as it gets. Now, why is this important now? It's important now because in March, the S&P 500 to money supply ratio hit a bottom, which basically means that we should be looking for returns 1 year out that somewhat resemble what you see in the left chart, which is extremely high market returns. And if you look at all the different commentaries that have come out over the last few months as the market rebounded as swiftly as it did, so many of them have, in one way or another, been talking about how it's inconceivable how the market has rebounded so much. It's inconceivable how it's rebounded as quickly as it has. Basically, everything's been inconceivable. And yet, you look at this chart and you can't help but come away from the conclusion that with something that has results about as clear as day as this, it's not really that inconceivable. And so this, I thought, was also something important to keep in mind within the realm of what are the things that we do know? And so none of the market performance we've seen recently should be that much of a surprise when you keep this in mind. So I think now what I'll do, I mean, these first two slides are basically almost like a, kind of interesting out of the ordinary introduction, but let's take a step back and look at some of the more traditional information that investors look at. So we'll start with economic growth. We focus on economic growth with two data points primarily. One of them is industrial production. One of them is the ISM manufacturing index. Why is it that we don't necessarily focus much on GDP? That easily could be a conversation for another presentation and probably for, a multi-100-page dissertation of some kind. But in a nutshell, GDP is an extremely blunt tool for measuring economic growth, and it comes out quarterly. We live in a world with, the high-speed data, loads and loads of data, and we're relying on the primary economic growth indicator as something that comes out quarterly. So this data, the industrial production index in particular, it goes back decades and decades and decades. I mean, we're talking the early 1900s. Every country in the world has an industrial production indicator. I mean, this is definitely something you could safely rely on. And what the chart shows you I'll give a quick explanation, by the way, of how do our charts work. It's very simple. The blue line in our charts represents what our predictive models predict. Approximately, and I say approximately because it changes depending on what we're trying to predict, approximately 2 years in advance. And I emphasize that for a reason, just to keep in mind when you look at how much the lines overlap, to keep in mind approximately 2 years in advance these predictions are made.
Alan, I got to break in here for a couple of questions. So somebody wants to know how your correlations lead to causation. And then the second question was, are your charts tautological? Of course, prices decline after peaks and rise after troughs. Is that definitional?
Okay, so let's take the second one first. Actually, you know what? This just popped into my head. The best way to think about it is think of it as a variation of a PE ratio, in the sense that a PE ratio is always looking at what is the price of the market, or frankly, anything else that you're looking at, relative to its earnings. And oftentimes, PE ratios are used as an input or a factor that hopefully tells you something about what future returns are going to look like. And of course, those future returns are essentially what the P in the PE ratio has as a starting point. So I guess the point there was it's no less useful than a PE ratio. But I guess the bigger takeaway I would give is we're not going to hang our hat on that uncertainty to certainty ratio analysis that we did, precisely because the results weren't nearly as statistically significant as what we strive for in our actual market predicting models. It was really just to show that if you kind of take a step back from the uncertainty argument and you actually compare it to certainty, you get remarkably useful results out of it. And then in terms of the first question, which all of a sudden escapes me, Marty, what was the first part?
Yeah, how does the correlation in your charts lead to causation?
Oh, so I'm going to guess that hopefully, or I think, relates to the previous slide. It's not that it. Well, we do think it leads to causation. I guess what I was going to say is whenever you have a good correlation, it doesn't necessarily mean there's a causation. But first, I would say that before I did the analysis, I did in fact have a theory that it makes sense, at least to me it made sense, I guess, that the changes in the level of uncertainty to certainty over time should give you an idea about whether investors would be more optimistic or would be trending more optimistically about the market or less optimistically about the market. So I guess that's some of the theoretical backing behind what drove the analysis. It definitely was not a case of the, well, I can't think of a diplomatic way to say it, so I'll just say what seems to be the rampant data mining that happens in the financial services industry, where you don't start with a theory. You basically run a lot of numbers to find good results, and then you find a good way to put the theory around the results. This was by no means that case. I mean, I definitely didn't start by thinking, oh, let's go to Google Trends and compare certainty and uncertainty. It was very much a matter of, I think there's a reasonable chance that uncertainty to certainty and how it changes could actually indicate how confident or not confident investors are about where markets are going to go.
Gotcha,
So,
Alan. We got about 5 minutes, so if you can keep going.
Yep. So in terms of economic growth, again, so the way that the charts work, always keep in mind the blue is the predicted. It's predicted 2 years in advance. The part of the blue lines that you will always see far off to the right, that kind of go more to the right than the last green data point, reflects what our prediction going forward is going to be. Now, the reason we show all the prior predictions next to it, just as a side note, is because in much of the investment management, financial services, research industry, what you'll find is that the research they show gives you only the last data point of real data, and then they add their forecast after that, which really tells you nothing about their accuracy before that. So we keep everything here so you can see how accurate was it beforehand and where do we expect it to go. So economic growth, we think it's going to improve, but it's going to improve from a very low level, and it's still going to end the year in negative territory. In terms of where we expect the market to end up at the end of the year, our forecast for the S&P is 3530, which would be, now here's the funny thing, if we didn't have any sort of pandemic experience, a 3530 on the S&P would simply represent a 9% year-over-year return relative to 2019. I don't think anybody would find anything strange about that. The only reason it sounds strange now is, of course, because we had the pandemic and the incredible impact that it had on the markets earlier in the year. But what our models are showing, and we would argue they've been pretty accurate, in even including, by the way, pre-COVID and shortly after COVID, because what you'll notice is that high data point on the green line all the way to the right, that represents an incredible outperformance of the S&P in December 2019 relative to what our model expected. What does our model tell us is going to happen when something like that takes place? It tells us there's going to be a huge sell-off. Now, I'm not going to argue that I had any idea in December 2019 that there was going to be a pandemic or anything along those lines. But what this tells you is there's going to be a huge sell-off. Of course, what happened 3 months later? That's exactly what we got. Now, the green line, of course, ended up falling below our model at the end of March. And it fell quite a bit below that as well. What does that indicate? That indicates there's going to be a significant bounce in the market. What ended up happening? Exactly that. We've had a market that bounced considerably. So anyway, if you follow that blue line all the way to the right, that last data point tells you that we expect a 9.3% change year over year on the S&P, which means 3,530 on the S&P by December. That is our target for the end of the year. And finally, on interest rates, again, the model, the charts, they work the same way with the blue and the green, how you interpret them. Our expectation is that the year ends with the 10-year at 1.25%. That is quite a bit higher than where we are today. We would argue, actually, as a side note, that this is one of the good reasons why we think clients work with us, because when you're living in a world where interest rates are so exceptionally low, it doesn't take large moves in interest rates to have a large move on the fixed income holdings in your portfolio. So if you have advanced notice on when those moves will be, the magnitude of those moves, that can help you hedge or manage around your fixed income holdings. So again, 1.25% at the end of the year. So I'll end there in the interest of time, and I'll just say, if you or anyone you know might be interested in having market forecasts for major asset classes all over the world that are made 2 years in advance with remarkable accuracy, please don't hesitate to reach out.
Thanks, Alan. That's really helpful. And what are your general thoughts for the next? So I guess the question, and again, Leonard Levy's been putting valuable questions all day. But what's your general outlook in case of COVID reemerges? Does your analysis ignore that, or does it include it, or?
So in terms of the analysis, the most important thing that I tell prospective clients is that the analysis and the models we use to predict markets are remarkably simple. The number of data points we need to create these models is remarkably simple. So few that I wouldn't actually even tell you. And the reason why I say that that's the most important thing for me to mention first always is because when you live in a world of big data, artificial intelligence, computing, supercomputers, the expectation is that, oh, well, if you really are predicting markets, you can only possibly be doing that if you somehow got your hands on a supercomputer that has every data point in the world and it's doing it that way. No, not at all. Very few data points. It was based on a theory that honestly, while I was at Goldman, was sort of swirling in my head for many years, that I finally started trying to put to use, and I've been blown away by the results because it's the same theory applied to every market around the globe, and the results are the same in the sense that the accuracy seems to be across the board.
Well, that's really great, Alan. And again, there's been a lot of questions that we don't have time to answer,
Sure.
but we'll make your presentation available to everybody.
Absolutely.
We'll have everybody contact you who needs information from you. And your video will be available in the next week for
Perfect.
people who want to view from the internet.
Great.
So thank you so much. And again, very thought-provoking.
Thank you. Thanks for everyone for joining in. Thank you.
Great. So we're very lucky to have Jeff